Right. So last week we covered fixed income securities. Right. We did a little bit of evaluation on bond calculations, right, based on time value of money. So you would have understood the importance of time value of money, isn't it? By the way, there is good news and bad news, isn't it? Because well, the bad news being the lockdown has been extended by another couple of weeks, right? So we don't have to remain indoors, and we won't be able to meet at least for another 2 weeks until things open up. But then the good news is all the bars are open, right? So we are free to have a booze after some time, yeah, and we can enjoy while we are at home, isn't it? Just a second, guys.
So can I ask you a question?
Yeah.
This is not regarding the subject.
Ah.
In case of our country,
Yeah.
now we have been downgraded now our country's credit rating. Then if in case of we default any payment,
yeah,
what is the effect of the banking sector if we default?
Effect on the banking sector?
Yes.
Well, I don't think we will default, right? That's mainly because there are, well, a couple of days ago, even the central bank, the new central bank governor, and the secretary to the president also, they reiterated that all the cash flows are expected. Cash flows have been lined up to repay all the external debt, and there will be absolutely no default on sovereigns, right? So I have every confidence that we will be able to repay the sovereign debt. But there have been instances where countries have defaulted, right? Sri Lanka so far have had, Touchwood, have had an unblemished record on sovereign debt service. In fact, even next week there is a coupon that is falling due, right? So I'm sure everything will be settled. And there are some investments that have been lined up, bilateral swaps, Chinese swap, perhaps a few loans from here and there. Right? So chances are we will not default, but countries like Venezuela, Argentina have defaulted in the past. So what you asked is quite a good question. The impact on the banking sector. What might happen is if there is a default on the sovereigns, all the dollar borrowings, right, the dollar borrowings that the banks have might get immediately called. I'm just assuming, and I don't know if that will be the case. Immediately called meaning the banking sector, all the banks will be asked, will be asked to settle all the outstanding loans. Right. So if that request comes, banks will be short of liquidity to settle dollar loans because they would have borrowed from overseas, and they obviously will not have funds immediately to settle dollar borrowings. Right, so there will be default on the banking sector as well. But that is on the external front. Locally, I don't think there'll be too many issues, other than maybe there'll be interbank swaps or interbank dollar settlements happening. Things like that. There might be a few hiccups here and there, but even those probably will be converted into local currency and settled, right? I'm not sure how the mechanics are going to work. But what I feel is, other than the external sector, domestically, there won't be too many issues, right? Because for you and I, we still have to put our money in the banks. No? There is no other option, right? So even if the country defaults, which will not happen, so if let's say this was Argentina, and if there was a default, we still have to go through the banking system. So then it doesn't make sense for us to withdraw money in banks. No, where are we going to keep the money, right? So locally, I don't think there'll be too many issues. It's just the external thing that we have to manage.
Okay, sir. Thank you.
Right. Yeah. So let's not have undue fears that the country will default. Let's have faith. I'm sure things will be fine, right? So if you're investors, I think the ideal asset that you should invest in, if you're foreign investors, perhaps you should try and buy Sri Lankan sovereign debt. For one thing, is the interest rates are going at about 20, almost 30%. 30% on dollar-denominated assets is a fantastic return. So if there are investors who are willing to invest, I think this is an ideal opportunity to invest in Sri Lankan sovereign debt. The other thing is, well, a couple of days back, some of the top officials were commenting that Sri Lanka will not go for any more sovereign debts. And so we have about $14 billion of sovereign bonds outstanding. Once those are redeemed, there won't be fresh sovereign debt for some time, right? So the amount of sovereign debt that is out there in the market is also going to reduce, right? So the demand will definitely increase, which means the 30% debt, when what happens to a bond when the demand goes up? Bond yields will, what happens to bond yields when demand goes up? Good question that you asked. Now, you all are maestros of bonds, no? Right? We discussed bonds last week. What do you think will happen to sovereign yields when the demand goes up? Think in terms of fundamentals, then you will understand.
Yields will down since the price goes up because the demand is high.
Yeah, very good. Very good. So when demand goes up, right, the price goes up, no? Demand and supply, remember what we learned in grade 2. So when demand goes up, price goes up. When the price goes up, there is an inverse relationship between bond yields, or bond price and yields. And so when the price is going up, the yield will drop. That means currently the yield is about 30-40%. The yield coming down means it will drop to come down quite drastically, right? So there is an opportunity to make significant capital gains as well as a significant return. Imagine 40%, not in rupee terms, but in dollar terms, right? So that's 40% in dollar terms plus the rupee depreciation of 5 to 10%. It's about a 50% return. Fantastic return if you're a foreign investor. So there are a lot of opportunities. Clear?
Yes, thank you.
Yeah. Right, so if there are no further questions, let's get cracking on today's area. Right, now, when you purchase a bond, right, or shares, let's forget bonds and shares. Let's take a thing like, let's assume that all of us are vehicle dealers. I know these days, dealing vehicles is a tough business, might be a good business, in fact, although imports are restricted. The second-hand vehicle market has gone through the roof now, right? Isn't it? Vehicle prices have gone, well, almost doubled, perhaps increased more than beyond that also. So vehicle market is doing very well, right? Second-hand vehicles. If you are a dealer, if you buy a vehicle, inevitably, what is your intention? What would be your intention if you buy a vehicle? If you're a vehicle dealer, you're in the vehicle business.
To sell.
Yeah, you obviously will want to sell it. But if you're a vehicle dealer and you sold your personal vehicle, then you might buy vehicles, one vehicle or two for personal use, right? Or if you're an individual, you're not into vehicle business, you buy a vehicle to use it until you retire or until you die, right? Which means people invest in assets for various reasons, right? Might be to as a long-term investment, right? You buy maybe a piece of land as a long-term investment. When your kids get married, you give it away as dowry. Or you might be a dealer in land, right? Property dealer. So in that case, you might invest in land to resell in a couple of years. When the price goes up, you try to resell. And so your intention might be different. Now, at the time of purchase, you need to decide what you're going to do with the piece of land, right? Whether you're going to put up your own house or are you going to sell it, things like that. Now, the same thing applies when you invest in financial assets, right? If you buy maybe a treasury bill, a treasury bond, or equity, you need to decide what you're going to do with it. So, are you going to keep it for the long term as a long-term investment until it matures, or are you going to sell it off somewhere on the line? Right. So that can be your intentions, either to keep it to generate revenue or to sell it off to make a capital gain. Right. So your intention is different. So based on your intention, you need to classify or account for them differently. Right. Now, if let's say you're a vehicle dealer and you bought a vehicle for 10 million rupees, right? Your intention is to sell. You will not hold it for long term, right? If you want to sell it maybe in a couple of days or about a week, and all of a sudden if vehicle prices come down, right? You bought for 10 million, if the price is 5 million, then you might have to end up selling it at 5 million and you would make a loss. But if the price goes up, if it goes to 11 million, then you can easily sell it and make a profit. Okay. But if you had purchased it for long-term use as an investment, then regardless of the price fluctuations, you are not going to be too worried because your intention is not to sell it. So regardless of what happens to the price, it doesn't matter. You're going to keep it with you as an investment. Same thing applies for financial instruments. If you buy a treasury bond or if you buy a share and your intention is to trade on it, then the price fluctuation is going to hit you. But if your intention is to keep it for the long term or to keep it until it matures, short-term price fluctuations really should not matter, right? So there is an accounting standard which deals with classifications based on your intention of what you're going to do with the asset. And now IAS 39 was the old one, the old standard. So we are not going to spend too much time on it. Based on IAS 39, there are 4 accounting categories, right? First one is called the held to maturity, fair value through profit and loss, AFS, right, and loans and receivables. Those are the 4 categories, right? The trading portfolio available for sale, loans and receivables, and held to maturity. So IAS 39 on financial instruments is about recognition and measurement, outlines the requirements for recognition and measurement of financial assets, liabilities, and some contracts to buy or sell financial items. Financial instruments are initially recognized when an entity becomes a party to the contractual provision of the instruments and are classified into various categories depending upon the type of instrument, which then determines the subsequent measurement of the instrument. Right? IS 39 was reissued in 2003 and applies to annual periods beginning on or after the annual 2005 and will be replaced by IFRS 9 on 1st January 2018, right? So it's now the current standard in place is IFRS 9, okay? So IS 39 I gave only for your information. You don't have to memorize it, but you have to focus on IFRS 9. The good news about IFRS 9 is there are only 3 categories: fair value through profit or loss, fair value through other comprehensive income, and held to maturity. Financial instruments within the scope are all of these: cash, demand and time deposits, commercial papers, loans and receivable payable, debt and equity securities, that means treasury bills, bonds, or shares, This category includes investments in subsidiaries, associates, and joint ventures, asset-backed securities such as collateralized mortgage obligations, repurchase agreements, and securitized packages of receivables. The derivatives, right, includes options, rights, warrants, futures, forwards, and swaps. So the fair value, this is the concept that we deal with most often in accounting. Fair value means the value that can be assigned to an asset or liability during an arm's length transaction. Right. The estimated value of an asset and liability of an acquired company used to consolidate the financial instruments of both companies. Fair value is used as a certainty of the market value of an asset or liability for which the price cannot be determined, usually because there is no established market for the asset. Now, if you're going to sell a company, right? Let's say you're going to sell Coke. Coca-Cola is going to sell its brand. So there is no readily available value for the brand Coke. Right? There are other ways of arriving at the intangible asset, maybe the brand value or the goodwill of Coke. And that measure is called fair value. The amount at which the asset could be bought or sold in a current transaction between willing parties or transferred to an equivalent party other than in a liquidation or sale. Liquidation sale, because in liquidation, when you liquidate a company, you will not get the fair value of the company. You will not get the rightful value, right? So it has to be between two willing parties. Now, it's like it should not be a forced marriage. It should be a willing marriage. Like the groom and the bride should be willing to get married, not a forced marriage. If it's a forced marriage, you will not get the actual value or the fair value. So IS 39 had 4 categories: financial assets at fair value through profit or loss, FVPL, available for sale, loans and receivables held to maturity. These you don't have to memorize, but IS 39 led to IFRS 9. Right? So it's easy if you know how it evolved. These categories are used to determine how a particular financial asset is recognized and measured in financial statements. Fair value through profit or loss or held for trading. Right? The changes in fair value under FVPL has to go in the P&L. Right? Whether it's realized or unrealized, it has to hit the P&L. Then available for sale, if it's treasury bills or bonds. If it's treasury bills or bonds and AFS, then the AFS adjustment or the adjustment in the fair value has to get recorded in the other comprehensive income, right? Or it does not hit the P&L, okay? But if the moment you realize it, then the change in fair value should hit the P&L, right? Loans and receivables, things like FDs, money market loans, should get recorded in loans and receivables. Held to maturities, you don't recognize the change in fair value, right? Now, this is the most important thing. Classification, the differences between IAS 39 and IFRS 9. So IAS 39, remember, has 4 major categories: FEPL, AFS, HTM, and loans and receivables, LNR. Whereas IFRS 9 has 3 categories. This is what you should remember. Right. So these are the three main categories: FETPL, FEOCI. Can you all see the Excel, by the way? All of you on the Excel sheet?
Yes, sir.
Okay. And the three main categories: FEOCI and HTM. FETPL, all the fair value changes should go through the P&L. FEOCI, fair value changes will get routed through other comprehensive income. But at the time of sale, if it's a fixed income security like a treasury bill or a bond, it goes through the P&L. If it's equity, it has to go through the balance sheet. It hits the balance sheet, right? Then HTM, all changes, none of the changes will get recognized, right? All the assets have to be categorized. All assets categorized as HTM cannot be sold. So fair value changes will not be recognized. It's only at book value. So those are the three main categories on the IFRS 9. At impairment of assets, the next standard IS 36, impairment of assets, meaning if there is any evidence that the value of an asset has gone down, you have to account for it, right? Applies to these categories. The most important standard, remember, is IFRS 9. These standards will not get tested. Some of the key definitions: impairment loss is the loss due to an impairment of an asset. Carrying amount is the amount at which the asset will be recognized in the balance sheet after deducting accumulated depreciation and accumulated impairment losses, which means the book value of an asset. Recoverable amount is the high of an assets. Fair value less cost of disposal and its value in use. That means the net present value. Fair value is the price at which price that would be received to sell an asset or paid to transfer a liability in orderly transactions between market participants at the measurement date. The value in use is the present value of the future cash flows expected to be derived from an asset or cash generating unit. Identification of impairment at the end of every reporting period. You have to do an impairment test and figure out what is the recoverable amount. Right. Indications, external or internal factors can be used. Things like the market value dropping, changes in technology, like remember what happened to Nokia and Kodak, right? So technology improved to an extent at which their products became unviable. Then increases in interest rates. If interest rates go up, obviously what we learned last week, the value of fixed income will fall. So if you have invested purely in bonds and if interest rates have had a sudden shock and gone up, then the value of your assets will fall, right? So you need to see whether you are able to settle your liabilities using the long-term assets. Now, the classic example I can give is the Orange County case, right? Remember what we learned about Nick Leeson's Barings Bank? There was a similar, not a similar incident, but another incident called Orange County, right? A US county in California had to file for bankruptcy because now the treasurer called Bob Citron, and Bob Citron had a very simple trading strategy. He will borrow short term, invest long term. So his assets are long term assets, and his borrowings are short term borrowings. And now this guy had this strategy, very simple strategy, and for as long as you had upward sloping yield curve, he made lots of profits. Right? No one complained when Bob Citron was making money. No one saw the risk, right? So what he will do is he will invest maybe 10 years at a rate of 5%, and he will keep borrowing at short term, maybe overnight or 1 week at rates of 1 or 2%, right? So all of a sudden interest rates started going up, and Bob Citron's now returns fell below his borrowing cost, right? Eventually that ended up with Bob Citron and Orange County incurring massive losses, thundering losses, right? They couldn't they couldn't withstand the shock, right? Because now remember, when interest rates go up, the value of your fixed income will fall. So this guy has invested in long-term assets, meaning he has long duration assets, right? So so long duration assets and short duration liabilities, right? So duration of assets of, let's say, 20 years, duration of liabilities 2 years. When the interest rates go up, duration of asset is long, so there is a huge drop in the asset value. Whereas the liability value, there is only a small drop. Right? So asset value came right down, liability value was above that. So when the liability value is more than the asset value, you end up with negative net worth. Right? So when the negative net worth exceeds your equity, you have negative equity, meaning you are making losses. You can't survive. You will not become, you will discontinue to become a going concern. That's when companies wind up. Right? So remember, if there is interest rate increases, steep interest rate increases, you might have to impair net assets of the company being higher than the market capitalization. Right? Now, take for example, if the market capitalization is, say, $1 billion, right, and your net assets or the book value of your company is 2 billion, that means the only way to realize your net assets is to sell your equity. No? So by selling your equity, you can only realize about 1 billion, whereas your net assets are worth 2 billion. Okay, so that also can be a sign of impairment. Internal sources, obsolescence, or physical damage, right? Maybe there is a fire or flood, physical damage, obsolete, everything expires, right? Nokia, right? Obsolete. Assets are idle or part of restructuring or held for disposal. Obviously, they will go to waste. Worse economic performance than expected. Investment subsidiaries, joint ventures, or associates, the carrying amount is higher than the carrying amount of the investee's assets, or a dividend exceeds the total comprehensive income of the investee. Right, so these can be indications of impairment. Right? So if there's impairment, you have to account for it. That's called asset accounting. Any questions? No questions? Right. Chanel, you have said yes. What was the question?
No, so that was previously asked question. I said yes. You asked whether we can see the Excel sheet. I said yes for that.
Right. I only saw your response. Sorry about that.
Sir, can you share the Excel for a bit?
Excel, yeah.
Because I have to write down class.
I can send you all the Excel. Or you can even say take a screenshot, I believe. Can't.
Okay, sir, I took a screenshot. Thank you.
Right. You all should be high-tech guys, no? Don't write down. And that's what your ancestors used to do.
How this will be tested, sir? It means how the questions form?
Pardon?
How the questions formed in this area?
Well,
Where it's tested?
can't remember. I think yes. Questions, the only thing they can ask you is the categories and their basic features. How you would categorize certain assets. I can't remember whether it was tested. Very easy, if it's tested. This is all you need to know. This covers everything.
Only the IFRS 9, no? IAS 39 is no needed.
No need. IFRS 9. Okay. This is all you need to know. Easy, no? So you'll be lucky if it's tested, isn't it? Just remember the three categories and the basic features of the three categories. Right? So they might ask, if at all, they will say you are a bond trader and you purchased treasury bonds maturing in 2041, right? And your intention was to trade, right? Then now this is the kind of question I will ask you if I was the examiner. Right? Then I might ask you what would have been your view and why you bought bonds in that case, right? Then I might ask you what is your risk, right? And I might say if interest rates are increasing, should you invest in long duration bonds, in long duration bonds, short duration bonds, low coupon bonds, or high coupon bonds, and explain why you made that decision. Okay, these are the questions I will ask. Then I will also ask what will be your accounting classification? What is the standard that applies, and what is your accounting classification? So answer is IFRS 9, FVTPR, right? Then if you sell this bond at if you bought the bond and interest rates move up, what could be the implication on your mark to market? Things like that, very basic questions, just to see whether you understood the basics. If you understand the basics, very easy to answer those questions. That's all the examiner has to test. He doesn't have to test anything else. Okay. So that will give a holistic view of whether you understood fixed income as well as the accounting classification. Understood?
What do you mean by amortized cost?
I think we discussed last week. You bought a bond at a price of 105. Right? Are we on the Excel sheet? Is the Excel sheet, right?
Yes, sir.
Okay. And if you had purchased this on the 19th of September 2021, right, what would be the cost when it matures on, let's say, 1st October 2025? What would be the face value, right, when it matures on 1st October 2025? This we discussed last week also. Yeah, what face value will you get when it matures? Hello? Let's say this is 1st October 2021.
100.
Yeah. When it matures, you get 100. It's a 4-year bond, isn't it? 4-year bond, you're buying at 105. When it matures, you get 100. That means during this 4 years, the value of the bond will drop by 5. You're buying this bond today at a premium, isn't it? Face value is 100. You're buying today at 105, which means you have bought it at a premium, right? What is the premium you purchased?
5.
Yeah, premium is 5. Which means over a period of 4 years, the premium drops by roughly 1.25 every year. It's not exactly 1.25, but around 1.25 every year, right? So that reduction in the premium is called amortization. Every month, this amortization happens. Hold on, guys. Battery is running low. Okay. So within a period of 5 years, the bond value drops by, or the premium reduces to 0. Right? From 5, it reduces to 0. That means the premium today is 5. And when it matures, the premium is 0. 5 drops to 0 within a period of 4 years. That reduction in premium is called amortization. It happens, in fact, not only annually, but even monthly or even daily it happens. The reduction in the premium is called amortization. Likewise, if you had bought it for a price of 90, when it matures, how much would you get? When the bond matures, you will get how much?
100.
100, right? So the face value is 100. You have bought it at 90. That means you have bought it at a
Discount.
of
10 rupees.
yes, discount is 10 when you buy, and when you sell, the discount is
0.
0, right? So the discount also gradually reduces. That's called amortization, that process of either the premium or the discount reducing is called amortization. Clear?
Clear, sir. Thank you.
Any other question? No? Right, so let's move on to the next area on business valuation. Right. Let me see whether I can show you an example. Well, see, look at this Warren Buffett statement, right? Price is what you pay, value is what you get. It's the concept of value investing, right, that we are going to talk about. First introduced by Benjamin Graham, David Dodd. You don't have to remember the history. Valuation, right? Valuation is the process of determining the value of an asset. Steps in equity valuation: understand the business, forecast the company's performance, select a suitable valuation model, and convert the forecast into a valuation. Right. Very important steps. You need to understand your business. Now, take for example, these days, a company like Expolanca, right? Amazing journey from last year. It has been increasing from about ₹1.70 last year to a value of 190. It settled down at 160, but expectations are it will go up further. Right now, why did this company increase in value? I'm just taking Expolanca as an example, right? What happened? Well, one thing is it was into freight, and all of a sudden there was COVID. So people, the travel restrictions were there, and flights were also restricted. So freight rates started increasing. Then freight rates have hit all-time high, right? And Expolanca was in the business of freight. Their share price kept increasing because their turnovers and their bottom line also kept increasing with it. Right? So you need to understand what sort of business Expolanca is getting into. Then they kept expanding in overseas countries, right? Also in locally, there was a dollar shortage. So their revenue, 95% of the revenue of Expolanca is in dollars. Meaning, also they started getting solid customers, right? From a customer base of about 20, they increased it to about 70. Right? Some of the best brands are with them. So turnover and the volumes also kept going up. Right? So you need to understand the company or what sort of business they are into and what is driving the business, right? What are the underlying factors? Things like that have to be analyzed. Then forecast the performance. Quarter on quarter, what is happening to the company? What is happening to exchange rates? What is happening to the freight industry globally? And now this is a local company. The headquarters in Sri Lanka, but it is based, most of the business happens in the US, 90% of business in US, and more than 75% is owned by the Japanese, right? So it's a Japanese company, headquarters in Sri Lanka, and all the business is in US. Right? So you have to go to that extent to understand the nature of this business. So you have to forecast its performance. How is the freight rate going to be in the future? Right now, this is the second quarter, which it's called the tech month, right? September is the tech month. Then you go into the Christmas season. So the second and the third quarter is where the business is at its peak. And the first quarter is where the business is at the lowest. So the lowest demand season, they gave 6 billion rupees of profits. Now, right, quite phenomenal, and expected to increase exponentially, right? So you need to forecast the performance. Then you need to select a valuation model, something like the PE ratio. Right? Okay, so when you compare the PE, you can compare it with many PEs, right? Maybe you can take Expolanca's trailing PE, which is around 5. Then you can take the Sri Lankan market PE, which is about 10, right? So look at 10 and 5. Looks like Expolanca is undervalued, but then you can even look at it as I said, it is a global business, right? You can look at it as the global freight PE is around 18, right? So it's whereas Expolanca is around 5, which means it's heavily undervalued, right? Expectations are the price might go up, things like that. Then you need to convert the forecast into valuation. That's why you take the PE of 18, multiply the global PE of 18, multiplied into its earnings per share, and get the value. Things like that has to be done. That's the kind of detail you have to go into when you want to invest in shares, equity, right? So you can do that for any company in the market. Okay. Intrinsic value. It refers to the value of an asset estimated by someone who has complete understanding of the characteristics of the asset or the issuing firm. Now, take the valuers who are working closely with most of the banks, right? You can be maybe valuing vehicles or land, right? So when you give loans, you go to the valuer and ask him to find the valuation or give a valuation report, right? Now the report, the value that he assigns to an asset is called the intrinsic value. Okay, so this valuer is supposed to have a complete understanding of the asset, thorough understanding of the asset. And market price does not always reflect the value. Price does not always reflect value. Price and value are two different things. Okay, so that is why you have so many buyers and sellers for shares in the market, because for some assets or some shares might be overvalued, they will want to sell, whereas for the others, some shares might be undervalued. So if you see it as undervalued, you will want to buy. If you see it as overvalued, you will want to sell. By estimating value, the analyst is assuming that the market price is not necessarily the best estimate of intrinsic value. Any questions up to now? Well, I went to get this pen. Now, why will you buy this pen? Simple question. Why do you think you will buy this pen? Or why will you buy a pen? I'm using a pen as an example, but it applies to anything. Huh? Could be a watch, a phone, a car, a shirt or a t-shirt or anything. Yes, even a land or a share or a bond, anything, any asset. Yeah.
It's a pen to fulfill the need of writing.
Yes. So why will you buy it?
You can't produce a pen because of it is a requirement.
It is a requirement. Okay. So if the price of this pen is say 50 rupees, or let's say it's 10 rupees, will you buy it or not? This pen is priced at 10 rupees. Will you buy it?
Yes.
But
Yeah. Then if I say the value of this, the price, sorry, the price of this pen is 1 million rupees, will you buy it?
no,
No? Why? You said you have a requirement. You still have the requirement.
but The value is so high. The value I have to pay is so high, not the value price.
Price is too high.
Too high.
Okay. But at 10 rupees, you're willing to buy. 1 million, you don't want to buy. Meaning there is something to it, no? The same pen. And you still have your requirement, right? For 10 rupees, you will buy it. For 1 million bucks, you will not buy it. Right? Now, let's say a glass of water or a bottle of water, right? A 1 liter bottle or a half a liter bottle of water, price is 50 rupees. You will buy or not? 50 rupees price. Will you buy it? Bottle of water?
Yes, I mean.
Yeah, you might buy, right? Then if the price is 1,000 rupees or 500,000 rupees, will you buy the same bottle of water? For 500, you will not buy. Now let's say the price of a water bottle is 50 rupees, half a liter. Now from morning you have been drinking water, right? Let's say yesterday bars were open, so you bought your liquor, you have hangover, and from morning you have been drinking water, nothing else but water, right? Right, and you have plenty of water at home, then will you buy another water bottle for 50 rupees? Will you buy another bottle of water for 50 rupees?
No.
You might not. Same price, you might have second thoughts. But let's say you're lost in a desert, right? Not a drop of water. Somebody comes with a bottle of water and tells you 500,000 rupees, the bottle is yours. Will you buy it?
Yes, if I have money, yes.
Yes, you might. Okay, meaning there is something that is going on, isn't it? Right? Something that depends on your need. Yeah. Right. Depends on your need. And based on your need, you're attaching different values. Now, if you're in the middle of an exam, right, and your pen is damaged, right, nobody has pens within a 1 mile radius, right? You have cash with you and somebody tells you this pen is available for 5,000 rupees. Will you buy it?
Yes.
Yes. Right. Why? Because you see a value which might exceed the cost of the pen. If the value is more than the cost, you will always buy the asset. You will buy any asset for as long as the value is more than the cost. Anything you buy is for that reason. Anything and everything. You get married also for the same reason, because you think the cost of getting married is less than the value you derive, or the value of getting married is more than the cost, right? Later on, you might change your mind, but initially that is what you think, right? The cost needs to be less than the value, or the value has to be more than the cost for you to invest in an asset. Am I right? Now, let's say you're planning to go on a trip, right? Someone says the cost of this trip is 50,000 rupees, right? Then you might think twice. Okay, then you will ask, right? Then if the person says pahantu dawa, right, you might be willing to go immediately. If not 50,000, you might spend 100,000 on the trip, right? So the value has to be more than the cost. Otherwise, you will never invest, isn't it? Agreed?
Yes.
Yeah. Of course, to go to Pahantadawa, you all will be willing to pay even more. No? Hello? All right. So that is the difference between value and price. Remember, you will always buy if the value is more than the cost. Right? And what do you think will happen if the value to you is less than the cost, less than the price? If the value you see is less than the price, what will you do?
Not buy.
Will not buy.
You will not buy, but if you already have,
Bargain.
if you want to buy, yes, you might bargain. But let's say you already have an asset. You have a car which is worth 20 million bucks. The price is 20 million bucks, but to you the value is only 5 million bucks, right? Let's say it is a three-wheeler. You have a three-wheeler, second-hand three-wheeler, which you bought from for fun. All of a sudden you realize that the price of the three-wheeler is now 10 million bucks, right? It cost you only 5 million. There are enough and more buyers who want this three-wheeler, even at 10 million rupees. What will you do?
Sell.
You will sell it. Exactly. Which means if the price is more than the value, it is always good to
Sell.
it's good to sell, right? You will then decide to sell. So if the price of this pen is, let's say, 500 rupees, and you have enough and more pens, there are enough and more buyers for this pen, you will look to sell this pen, isn't it? Which means, remember, you will buy an asset if what? You will buy an asset if the
Is higher than the cost.
not the price.
Value is higher than the cost.
If the value is higher than the cost, and you will sell an asset if the
Price is higher than the value.
price is higher than the value. Okay, so that means value is something subjective. Price is what is there in the market, what is quoted in the market. Understood? Right. Now, if you decide to buy this pen, if it's 10 rupees and you decide to buy, that means it is undervalued. But if the price is 500 rupees and you sell it, then the price, the asset is, or the pen is overvalued. You always buy undervalued and you sell overvalued. Clear? Buy undervalued assets, sell overvalued assets.
Yes.
Yeah. So estimated value and market price, you are comparing the intrinsic value against market price, right? So intrinsic value against the market price. Intrinsic value is the present value of future cash flows of a security. Present value of future cash flows. You can arrive at three conclusions, right? If the intrinsic value is more than the price, it is undervalued. Intrinsic value is equal to price, fairly valued. If intrinsic value is less than the price, undervalued, right? Undervalued, fairly valued, and sorry, if intrinsic value is less than the price, it is overvalued. So it can be either undervalued, fairly valued, and overvalued. If it's undervalued, you need to buy. If it's fairly valued, you can keep it. Or if it's overvalued, you can sell. What do you think? Can you go through this question? Estimated value and market price.
Overvalued.
Undervalued.
Undervalued and overvalued. Okay. So the average is fairly valued.
Overvalued.
Overvalued. Let's go through the question. An analyst using a number of models and range of inputs estimates the security's value to be 250. The security is trading at 260. So the security appears to be what? Undervalued, overvalued, or fairly valued?
Overvalued.
Overvalued. Okay.
Fairly
To help.
valued.
Huh?
Fairly valued.
Fairly valued. Okay. Why?
Overvalued.
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 Right. So why fairly valued? Fairly valued means the price should be equal to intrinsic value. No? So what is the price?
$260.
Price is trading at 260 means the price is 260. And the intrinsic value?
250.
250 intrinsic value. Right. So price is more than intrinsic value. Isn't it? If the price is more than intrinsic value, it is
Overvalued.
it's overvalued. If it's overvalued, should you buy it or sell it? You need to sell. Understood?
Need to.
No?
Yes.
Yeah, do you all agree or disagree that it's overvalued? It is overvalued, right? Price 260, intrinsic value 250. So price is more than intrinsic value. Therefore, it is overvalued. Remember the previous one. If the price is more than intrinsic value, it is overvalued. Valuation models. There are two types of valuation models, absolute and relative valuation models. So we'll be discussing three ways of valuation. Absolute valuation. Estimating intrinsic value using an asset's own investment characteristics. Intrinsic value is the present value of future cash flows of the security, right? Present value of future cash flows gives intrinsic value. Can be divided into discounted cash flow models or the dividend discount model and asset-based models. So absolute valuations and relative valuation. Absolute valuation, there are two main ways of doing it: discounted cash flows or asset-based. Relative valuation is where you compare with something comparable. It's about estimating intrinsic value of the asset in relation to the value of other comparable assets. The intrinsic value can be derived based on the value of similar assets using multiples, like the PE ratio or the price to book value ratio. P is the price to earnings ratio. Right, so let's start with discounted cash flow model. Is this absolute or relative?
Absolute.
Absolute valuation, right? Discounted cash flow model. So nothing new to learn. You know to discount cash flows now? This is the same thing that you have to do. It's based on the logic that individuals make an investment because they expect a rate of return over the investment period. So the value of the investment today should be equal to the present value of the expected future benefits. What is the expected future benefit of holding a common share? How would you benefit if you buy and hold a share?
Dividend income,
Yeah, dividend and
capital gain.
yes, dividend and capital gains, right? That's how you derive returns from equity. Dividend discount model. Right? If you have absolutely no intention of selling shares, if you want to be a long-term investor like Warren Buffett or let's say Bill Gates, right, where they invest in their company and they hold it until the real potential is realized, then this is something you could use, dividend discount model. Now the main disadvantage is some of these big companies like Microsoft, Amazon, they don't pay dividends. They don't pay dividends, so the only return you get is through capital appreciation. Right? So expected benefits from investments is mainly dividends, assuming business will continue for an indefinite future. So the intrinsic value will be the present value of future dividends expected to receive from the security. Now, this does not apply if the company does not pay dividends. And this is how you calculate, right? The total dividends you have to discount. Right? So there are a couple of things you could use. One period dividend discount model, meaning if you hold it for 1 year, right, then you can use the next year's dividend to arrive at fair value. If an investor buys and holds a share for 1 year, the intrinsic value is the present value of two cash flows, the expected dividend plus expected selling. It's not prince, it has to be price in 1 year, right? So it's the dividend plus the price over the next year, which you need to discount. Simple cash flow discounting. It's like this: you invest today at year 0, 1 year you receive the dividend plus the selling price, which you have to discount at the given discount rate. Right, so let's calculate this. One period dividend discount model. Apple shares are expected to pay a dividend at the end of the year, $5. The analyst estimates the required rate of return to be 10%, and the expected price at the end of the year to be $450. Current price is $400. Calculate the value of the shares today and determine whether Apple is overvalued, undervalued, or properly valued, right? So you need to calculate intrinsic value. At the end of the year, you're getting dividends of 5, and if you sell it, you'll get 450. Right? That means 5 plus 450, 455 you will get. You then need to calculate the discount factor. It is at 10%.
So can you share the Excel?
Okay, sorry, I got it. 413.64. Do you all get this? Sorry, there is another part to it. The current price is 400. Your intrinsic value is 413. Then what do you think? Is it undervalued or overvalued? Hello?
It's overvalued since 400 US dollars, but it was selling at 413.64.
No. Price is what? What you just calculate is what the price or the value?
Price.
No. What you just calculate is the value, right? It's the intrinsic value. You're calculating value. Price is there in the market. No? You don't have to calculate the price. Right here it's given the price is 400. But you just calculated is the intrinsic value, right? Remember? This is the intrinsic value. Here the price is given as 400. Okay, price is 400, value is 413.64. So it is what?
Undervalued.
It's undervalued. Yeah, if it's undervalued, you need to buy or sell.
Buy.
You need to buy it, right? So this case, Apple is priced at 400. Therefore, it is undervalued, so you should buy it. Yeah, any questions?
So this formula says dividend in period, but we consider 455.
Dividend?
According to this formula,
Yeah.
it says dividend in period, but we consider not the 5, we consider 455.
Which one? The dividend after the end of 1 year, no? $5, right? So if you sell it at the first year, you get 450, no? Isn't it?
Right.
Yeah, so you get a total of 5 dividends and 450 sales proceeds. So 455, right? Isn't it? Okay.
Yes.
So can you please explain why do you say it's undervalued? The market price is, I couldn't follow with me. I
If
couldn't
the
understand.
table, if the price is less than the value, price is less than intrinsic value, it is?
Undervalued.
Yeah. And if the price is more than the value?
Overvalued.
Yes.
So what we calculated is an intrinsic value, isn't it?
Yeah. Compare it with the price. Price you don't have to calculate, no? It's there in the market. No? If you go to the Kade, and you ask the price of a loaf of bread, right? Do you have to calculate the price, or is it readily available?
Readily available.
Readily available. The price is there always. What you need to calculate is the value. Clear? If you see a plot of land, the owner might say its price is 50 million, right? Price is readily available, but you have to see what the intrinsic value is. That is what you need to calculate. That's why you need to value, right? Clear?
Clear, sir. Thank
Yeah.
you.
The next one. Now, if you hold it not for 1 year, but for 2 years, right? So although we did a calculation for 1 year, you can do it for any number of years. Maybe you can think you're holding for 2 years and then selling it off. You can even say you're holding it for 5 years and then selling it off likewise, right? Now let's see what happens if you hold it for 2 years and sell it, right? Maybe on the first year you get, during the first year you get a dividend, then the second year you get a dividend and you're selling it off, right? So the first year dividend needs to be discounted. Then the second year dividend plus the sales proceed also needs to be discounted, right? To arrive at the value. So let's do a calculation and see what the value is in this case. Shall we try? 2-period dividend discount model valuation. Apple shares are expected to pay dividends Apple shares are expected to pay a dividend at the end of year 1 and year 2 of $5 and $10. The analyst estimates the required rate of return to be 10%. And the expected price at the end of year 1 and year 2 to be $415 and $425. The current price is $400. Calculate the value of the share today and determine whether Apple is overvalued, undervalued, or properly valued. Right, so let's try this. Now, they're paying dividends year 1, $5, year 2, $10. Return is expected to be 10%. Price at the end of year 1 and year 2 is 415 and 425. Now, if you're keeping it for 2 years, right? If you're keeping it for 2 years, the price at the end of year 1 is irrelevant because you're not going to sell it now. You're holding it until the second year. Whatever the price at the end of second year does not matter. No? So you need only to consider the year, second year, what is the price. Year 1 dividend is 5, year 2 dividend is 10. And the analyst estimates the required return to be 10% and expected price at the end of year 1, right? So you're keeping for 2 years, end of year 1 price is immaterial. End of year 2 price is 425. $364, isn't it?
$364, sir.
Yeah, 364. So is it undervalued or overvalued?
Overvalued.
It's overvalued, right? Price is 400, no? Yeah, current price is 400 and the intrinsic value is 364. Therefore, it is overvalued. If it's overvalued, should you buy it or sell it?
Sell it.
You have to sell it. Earlier one, it was undervalued. Therefore, you should have bought it. Now it is overvalued. So you have to sell. Clear? That's right. You should have got 364 because I think you would have missed the first year dividend. If you hold it for 2 years, you'll get the first year dividend also. You have to include that also.
So here it says 374, right?
Yeah, some mistake. Addition is wrong, I think. Should be 364. Okay. Okay, so let's move on. Any questions? Right. Now, if you're holding a share for an indefinite period of time, right, you don't know when you're going to sell, And if it's paying a steady dividend, which is growing progressively, you can use what is called Gordon's constant growth model. It assumes that dividends increase at a constant rate indefinitely. Right? So you're not going to sell it anytime soon, and the dividends keep growing. Right? That's called Gordon's constant growth model. Intrinsic value is the present value of increasing dividends. Right? So this is how you calculate. This is the formula. The value is equal to D0, meaning this year's dividends into 1 plus the growth rate divided by the discount rate minus dividend growth rate. Now, this year's dividends into 1 plus growth rate gives next year's dividend. So it becomes D1. Right, so let's try this. Apple recently paid a dividend of $1.80. An analyst has examined the financial statements and historical dividend policy of Apple and expects that the firm's dividend rate will grow at a constant rate of 3.5% indefinitely. The analyst also determines that required rate of return on investment is 10%. He has to calculate the current value of Apple shares. They have recently paid a dividend, which is D0, $1.8. An analyst has examined the financial statements and historical dividend policy of Apple and expects that the firm's dividend rate will grow at a constant 3.5%. So G is 3.5%. The dividend growth rate of G is 3.5%. The analyst also determines that required rate of return on investment is 10%, right? So R is 10%. He has to calculate the value of Apple. So let's give this a try. Current year's dividend 1.8. But I've been mentioning this as price. It has to be the value, intrinsic value. Any questions? Next one is called a multiplier model, right, which is a relative valuation model. Right. Price multiple refers to a ratio that compares the share price with some sort of monetary value to allow evaluation of the relative worth of an asset. It values a stock based on the average price multiple of stocks of similar companies, right? So if you are comparing, let's say, a banking sector company, you have to compare it with the banking sector average. So one ratio you can use is the price to earnings, PE ratio, or the PE multiple method. PE ratio is the market price of a share divided by, okay, so I hope all of you got 28.66, right? MK Technologies. Right, let's calculate PE of MK Technologies, which is the price per share divided by earnings per share. MK Technology shares are selling for $50, right? So market price is $50. They bought for $40, which is some time back, and earnings for the last 12 months were $2 per share. Right, so price of a share is 50, earnings per share is 2. So PE ratio is price of 50 divided by earnings per share 2, 25. PE ratio 25. Any questions on that? No? Now what you need to do is to compare MK Technologies with companies, similar companies in the industry, in the market. Right? So if MK's now PE is 25 now, but if the market PE is 30, that means MK Technologies is undervalued, right? So the only thing, because now if the entire industry is the same, then the whole industry should trade at the same PE. Industry PE average is if it's 30 and MK is 25. One thing to happen for the PE to increase from 25 to 30 is either the price should go up or earnings per share should reduce, from this formula. If the price goes up or earnings per share reduces, PE ratio will increase. Now, earnings per share is the last 12 months profit, which cannot change. You have already published accounts, it cannot change. Only thing can happen is the price to go up. Right? So if your PE is less than the industry, that means you're undervalued. PE multiple you can use using either trailing PE or leading PE. Trailing PE means the market price divided by the last 12 months earnings per share. Leading PE is the market price divided by the next 12 months forecast earnings per share. Okay, so trailing, remember, is the last 12 months. Leading is the next 12 months earnings per share. In both cases, you have to use market price of a share. So let's try this example on Byron Investments. Byron Investments reported 32 million in earnings during fiscal year 2007. And analysts forecast the earnings per share over the next 12 months to be €1. Byron has 40 million shares outstanding. The market price is 18 euros per share. You have to calculate their trailing and leading PE ratios. So they reported 32 million earnings during the fiscal year 2007. Analyst forecast EPS over the next 12 months to be earnings per share to be 1. There are 40 million shares outstanding. Okay. So let's do the trailing and leading PE. Market price is 18. Earnings per share the last 12 months, 32 million earnings, 40 million shares, right? So it is 32 million earnings divided by 40 million shares. You get a price of 22.5. And the leading PE, price is 18 divided by next 12 months earnings per share is 1. It will be 18. Trailing is 22.5, leading is 18. Right, so any questions on that? No questions, let's move on. Intrinsic value of a share in relation to comparable PE ratios. Intrinsic value is the EPS into comparable PE, right? It's the PE into EPS gives you the price. So let's try this example. MK Technology shares are selling for $50. Earnings for the last 12 months, $2 per share. The average trading PE of MK's industry is 32. Calculate the intrinsic value of a share and decide whether it's undervalued, overvalued, or fairly valued. What do you think? MK is at 50, right? Price is 50. Earnings for the last 12 months, trailing is $2. That means PE ratio is price is 50 divided by earnings per share of 2 is 25. Average PE of the industry is 32. MK is 25, industry is 32. Right? So this is you're using trailing PE. Only thing that can happen is the price to go up. So if the price has to go up, it is currently undervalued. MK is undervalued. Understood? For the PE to increase from 25 to 32, only thing that can happen is the price to go up, because earnings per share you're using trailing, last 12 months will not change. Only thing will happen is the price will go up. That means it is currently undervalued. Okay, guys, clear? So let's try this one also. It's somewhat similar. Consumer products has a trailing PE of 27.5, while the median PE is 33.25. Assuming there are no differences in fundamentals among peer firms, consumer products is what? It's still undervalued, right? Because industry is 33, consumer products is 27, meaning it has to increase to the industry level. Right? For it, the PE to increase, either price should go up or earnings per share should come down. If you're using trailing, earnings per share will not change. So the only thing that can happen is the price to go up. Price to go up means it's currently undervalued. Okay, so that's relative valuation. Another absolute valuation method is called asset-based models. It uses estimates of market value of assets and liabilities in arriving at the value of a share. Okay, so you have to compare always the market value of assets and liabilities, right? Not the book value, but market value. Remember, very important, market value. It's relevant for companies that do not have high proportion of intangible assets, right? So you can't have intangible assets, something like a software, intangible asset. You can't have that. Usually applies to companies that have physical assets. Let's try this. iPhone Limited has 1,000 shares outstanding. The market value of inventories and accounts receivable are as reported. Inventories 30,000, accounts receivable 15,000. Market value of net fixed assets is 120% of book value. Right, so cash has the same value. Accounts receivable, this carry correct value, recorded at correct value. Inventories recorded at correct value. Net fixed asset should be 120% of this. Using the asset-based value approach, estimate value per share from adjusted book values. So let's give it a try. Cash, accounts receivable, inventories. Market value of cash should be the same. Accounts receivable and inventory is also given as the same. Next week, net fixed asset should be 120%. Reported book value of liabilities reflect their market values, right? So liabilities, accounts payable and term loans are the market values. Meaning the adjustment, right? See, assets 134,000 means liabilities also should come to 134,000. Only adjustment can come from equity. Which has to be 89,000. liquid value should increase by 89,000, which comes from actually the reserves. Yeah, any questions? Equity valuations can depend on so many factors, right? Can be micro and macro factors. Macro factors include what happens internationally or within Sri Lanka. Things like the economic factors, political, legal, economic, social, technological factors. Then what is happening in the US, the Federal Reserve, what are they doing? How the impact is going to be in Sri Lanka, what is our external credit rating like? Are there signs that we will default on sovereign? So things like that, external. Whereas internal means what is happening within the country, within the company. And so all of these have an impact on the value of a company. So that's it for today. Time is also up, right? So we shall wind up for today and we'll meet next week. All right, so thank you very much. Have a safe week. Stay safe. I will see you all next week.